In this video, I break down a conference call with YieldMax that recently happened over on Twitter. I analyze the point that YieldMax strategist Mike Khouw made about ULTY beating the S&P 500 from a specific time point. We also get questions about stabilizing the YMAX NAV, and we look at how ULTY's new changes in the portfolio are affecting the distribution amounts. So without further ado, let's get into it. All right, so the first question we get asked is about YMAX and stabilizing the YMAX NAV. The questioner is going to ask if it's possible to put less volatile names into YMAX. So I thought I'd include this question and hear what they have to say.
I know we can't just put like the 0 DTE funds in there or something, but would you do lower IV names just to stabilize potentially YMAX, or is YMAX only going to stay how it is right now? I guess that was, if that's a question or a comment, that was what I gathered from the group mainly.
The thing about YMAX is that there are lower implied volatility names in there, including our funds. Trying to think of Berkshire, for example, like is a high volatility name, and the weighting in those in YMAX, is equal. So I'm kind of wondering, like, if there would be any solution for that, because at the end of the day, the fund is an amalgamation of all the YieldMax single stock products. So we include, single stock products that we have on lower volatility names, as well as the higher volatility names, and we want to offer a mix of those things. I haven't heard of any discussion about, maybe shifting weight towards something with lower volatility like Berkshire or like our Disney fund. But that is certainly, helpful feedback to get, and something that will relay to the fund managers. I don't know if that would require a prospectus change. I believe that it would, just based on the initial investment strategy and objective that are outlined in the YMAX prospectus. But certainly an interesting idea, and something that we will share with the portfolio managers of that fund.
The next question is going to be if distributions will decline over time. And now he doesn't mean, oh, will the distribution frequency stop declining, or will there just be fewer distributions? I think what the questioner means is, will the yield decline over time? In other words, if ULTY started with a yield of about 80%, will that ever drop to around 70% or lower? And listen closely to Michael Khouw's answer, but also check out this chart that I've pulled up of ULTY distributions over time. This is since they went to weekly, so I don't include the monthly distributions back here. And this last one, I've adjusted for the 10-to-1 split. So even though the most recent distribution was around 58 cents, I adjusted that to 0.058 cents, rounded up to 0.059. And you can see here that distributions have declined, especially since the NAV started shrinking in early November. So listen closely to the answer Michael Khouw gives.
My man Red Pill in the audience, maybe Michael Khouw, you can chime in on this as well. But he says, haters like to say that distributions will naturally decline over time. My understanding is there are only two things that affect distributions: IV of the underlying asset, or actual volatility, the quality of the option trades performed. Is there anything about your guys' ETFs that would cause distributions to naturally decline over time?
No. There's one thing you didn't mention that obviously has an impact as well, and that's the performance of the underlying asset. For the covered calls, you're long the stock and you're selling upside calls. You want the stock to rise. Hopefully you're getting good premiums for the calls you're selling. It is true that you will see regimes where implied volatility falls for a period. But volatility is a mean reverting process generally. So if it gets below some level, it's more likely to rise in the future from a low level than it is to fall, considerably further.
So take a listen to what Michael Khouw says next when he mentions structural changes to ULTY, because this was the call where they were anticipating talking about the prospectus changes, which would have to do with the underlying stocks within ULTY. But I think those changes have already happened. I don't know what they're going to announce, and I don't know if there's going to be any changes that we don't already know about because we're already looking at the portfolio every day. So I actually don't know if next Wednesday, when they're going to have the call and talk about the new changes in the prospectus, I don't know if we're going to hear anything different that would change what's already in the portfolio. So you guys tell me how you interpret this one.
And another interesting thing is that, we're going to talk more formally about structural changes to the security selection process and ULTY once, all of those filings are sort of publicly distributed. But I know that this is an informed audience, and I know that all of you are, you see what's in these funds. It's, updated every day. You guys we can see from the comments and from the questions that people are paying close attention to this. And names like Alphabet aren't particularly high volatility. And yet, if you just take a look at, say, the performance of ULTY over the course of, the last, call it 2 weeks, since November 20th or so, the total returns for ULTY are outperforming the S&P.
So pay attention to what he just did there, because he said the total returns for ULTY since November 20th have beaten the S&P 500. And he's not wrong. I'll throw up a chart here and you'll see that he is correct. Since November 20th, the returns for ULTY, the total returns, have beaten the S&P. The problem is that's when ULTY was at its lowest in price return. So I'm going to show you guys. This is ULTY year-to-date total return basis. So I'm going to switch to price return real quick. And you're going to see here, this low, April 8th, was the Liberation Day, the tariff, when the first round of tariff announcements were there. And price return, ULTY was down 39.5%. But November 20th, right here, ULTY is down 56.63% price-wise. And if we switch that to total return, we see that on November 20th, ULTY was, from a year-to-date perspective, only down 4.95%. From a total return perspective on Liberation Day, they were down 22%. So what I'm interested is ULTY versus the S&P since Liberation Day, since the 8th of April, how it's done. So I think that would be another interesting comparison, and we can do that right now. I think it's going to actually look pretty good for ULTY on a total return basis. It does look good for them. They're up 28.97% on a total return basis since their lowest point of total return this year. But the S&P is up more by, actually, by almost 10%. We'll call it 10%, because the S&P is up 38% since that time period. So I think going forward, when people start comparing ULTY returns, they should probably late November as a starting point, because that's when ULTY really started to change the types of stocks they were selecting, and it's starting to become a new fund in a way. So just thought that was interesting. Let's continue listening.
And the S&P's been doing pretty well over that period. Like the S&P's up like 4.6%, 4.7% total return basis, and ULTY's up more than 5% over the same period of time. And you guys have been observing, you probably noticed that Alphabet got added back on the 14th. It's not a high volatility stock. Why did that help us? It didn't help us because we were getting paid 80 implied vol to sell calls on it. It helped us because it's just been a great stock. It certainly didn't hurt that Berkshire Hathaway announced, or it was revealed to the market that they owned nearly 18 million shares a day after we bought it. And we certainly didn't know anything about that, but the timing helped. But there's been other good news too, right? So they had the collaboration with Broadcom and TPU side, and so there's been a lot of good things happening there. I mean, I thought the stock was ludicrously cheap at the beginning of the year anyway, kind of on the record for that. But my point is that, and this goes to to Wolf's initial comment, which is what drives returns. what drives returns is the performance of the underlying stocks, as well as the implied volatility that we get on those stocks. So that's really what I would think that as investors we're rooting for. We don't want to see super high correlations because we want to have a diversified portfolio, and a diversified portfolio isn't going to exhibit super high pairwise correlations between its constituents. So we want the stocks to go up. Hopefully we get some decent premium out of them. And, if the traders are doing their part, and they have been for sure, there are other ways that you can squeeze a little bit more vol out. The NVIDIA trade that they did, we don't have NVIDIA anymore, but
So weird that he would use the NVIDIA example, because NVIDIA was actually a losing trade for them. I explained this in another video, but they bought it at around 74 million, sold 72. They collected 1.8 million in options premium, but their realized loss on the trade was 1.9. So they actually, I think, all told, lost about, I think it was $12,000 on this. Let me just add up that and that. Yeah, it was a $12,000 loss by my calculations. If someone has different numbers, maybe I don't know, but yeah, they lost money on the NVIDIA trade.
that was an example of that, where they had the ratio put spread to the downside against the 400,000 long and short call spreads. Because, again, and this actually speaks to this too, when you guys see short call spreads, consider that, of course, you'd be collecting more extrinsic premium if all you did was to sell the call. But when you sell the call spread, what are you saying? You're saying, I don't want to collect as much premium. Instead, I would rather have more upside participation, because these are stocks we like. Stocks generally go up. Sadly, the dollar generally goes down. So you want to have some delta, and you definitely want to have some kicker delta in the event that some of these stocks really take off the way AMD and NVIDIA did several weeks ago.
And then another question comes from a member of the audience who asks about maximizing yield with options, and take a listen to Mike Khouw's response.
Is the plan to still write calls super close to the share price and max yield, or are we looking at potentially getting some growth in there as well?
I think the hope always had been that there would be some growth as well. I mean, a lot of the stocks that were in there had done pretty well from the beginning of the year, and certainly off of the post-Liberation Day lows through early October. I mean, Hood was in there, Palantir was in there. I mean, there's a lot of winning stocks. What did end up happening is that when we saw that big sell-off in crypto, the bloom kind of came off the risk-on rose, if you will, and the correlations in a lot of the stocks rose. That kind of circumstance, that conditional correlation, I think is less likely. The way the PMs and Mike Venuto, and if I may, to the extent that I'm also contributing to that, what we're looking for that portfolio to do, we want to have the benefits of diversification in it. And that's going to include, lower volatility names from time to time, and things that don't necessarily have that same tendency to swing together in market drawdowns.
Now, I'm going to give myself just a little bit of credit here, because back on October 25th of this year, I wrote a post on my Substack, which you guys can check out, Roger Sands Dividend Life, and subscribe. It's completely free. I wrote a post in Substack, and I made some suggestions for YieldMax. One of them was to waive the management fee, which I know they won't do. I did say trim the crypto exposure, and you heard him talk about how crypto was bad for the portfolio. I also added point number 3, they should add more positions that are less volatile, deploy it cautiously over the next few months, lots of small positions in stable names, nothing more than 1 to 2% of the portfolio. So I think they've done that. They've added less volatile positions. They haven't taken my suggestion of doing it cautiously. I think they still throw out big investments, and the positions are still relatively the same in terms of weighting, although you do see some that are like 2.5%, 3%. Max one is like 5%. So I just want to, take a little victory lap there.
In fairness, it should also be said that the sell-off in some of those higher volatility stocks also makes it possible to not have a portfolio that is completely, constructed of them, to still achieve very nice premiums on the options that you're selling, right? So as volatility rises, you could say, oh, well, are we just going to try to take the higher prices in that same basket of stocks, or are we going to use this as an opportunity if we are getting into a truly risk-off moment to say, no, let's try to keep attractive distributions, and let's use this as an opportunity to, improve the effects of diversification inside of the fund, inside of the portfolio. And I think when you look at the construction that's in there now, you're going to see that. I know that Mike Venuto in particular has made, comments in our meetings on this topic, where he's very interested in ensuring that at least a certain percentage of that portfolio is consistently going to be maintained in things that don't tend to have high correlations with, the other 70%.
So I think I'm going to wait until the next call on Wednesday to really understand what that means. It sounds like they might want to be holding certain positions for the very long term, certain very stable names, and they may not trade out of these as frequently, but I'll wait till the next call, and I think Mike Venuto is going to be on that call to hear what this actually means. So hope you guys enjoyed this video. If you did, if you found it useful, please do give it a like, and if you want to see more, subscribe to this channel. Hope everyone has a fantastic day, and see you in another video.